Okay, so hello everybody. We definitely are in the middle of a banking crisis in Europe. We are in the middle of a sovereign debt crisis, a fiscal crisis. We are more or less at zero growth in the aggregate, but also with quite a lot of heterogeneity between the countries of the north and the periphery of the south, in the south. And we have a political crisis. So here just a few of the last events. As you know, the Italian banks have been downgraded, the Spanish banks have been downgraded, and there is still persistent stress in the global banks in Germany and France, which I will argue are also a big part of this saga. I mean, we may ask ourselves, what kind of a crisis is this? Is it a financial crisis? Is it a political crisis? Is it a banking crisis? Is it a crisis of the real sectors? I think at this stage, we have seen it all, and now we are in the middle also of a political crisis, which will make the crisis resolution very, very difficult. Okay, so my take will be that the origin of this crisis is not fiscal, is not the sovereign problem. Okay, the sovereign problem was the result of the financial crisis, but is not what originated the crisis. And the roots of the crisis had to be found in the type of macroeconomic adjustment that we have seen in the years preceding the crisis, the way in which the northern part of the Eurozone interacted with the southern part. I will use this word south, but I include Ireland in the south, which geographically doesn't make sense, okay, but it's the periphery, okay? Now, the banks intermediated these capital flows, okay? So the banks were the vehicle, okay? So capital went from the north to the south. And what happened is that we got imbalances because these countries were borrowing, they're consuming, and so they were developing current account imbalances with respect to the rest of the world. Now, here, I think there is a point for reflection. In a way, there is nothing bad about capital flowing from northern, richer country to the south, poorer countries, because this is actually the way in which poorer countries develop in the world in general, okay? So when you are poor, you have a relatively poor, you're a relatively low level of income per capita. So when investing in these countries typically leads to higher returns than to invest in the north. So it makes sense, it makes sense for the north to invest in the south. And this could actually be the vehicle for growth. But this did not happen because of this distortion. This capital actually was not put in productive use because the incentives were there not in place. And actually exposed, now we can say that the financial sector took too much risk and actually fueled the credit boom that exposed was unsustainable. In a way, we have seen that at the larger scale in the global economy. We have seen it in a minimal, sort of in a miniature within the euro area. In that sense, it's a classic financial crisis development that we are seeing. It's not something so strange. So this is before the crisis, okay? Then the crisis comes, okay? The crisis has nothing to do with the euro area. 2008, Lehman Brothers, the other story that to be said. Hard landing. So the banks were badly hit because they were very, very fragile already. And then there was a sudden fiscal deterioration, partly as an effect of the recession, and also partly as an effect that the banks had to deal with, that the sovereign had to deal with the banks. Okay, this is typically the case of Ireland. And then, this is where the sovereign story starts. So let's open this little chapter, the sovereign problem. And so the problem here is that in a monetary union, you cannot bet on the exchange rate, okay, because that the exchange rate is common. Like if you had been in the early 90s, before the EMU, in a situation like that, there was a recession in the early 90s, what happened? That the markets started betting against exchange rate, and then some countries had to get out of the fixed exchange rate mechanism. So we had an exchange rate crisis. Okay, here we could not have an exchange rate crisis, so we had a sovereign crisis. So basically, the sovereign crisis is an exchange crisis in disguise. That's the idea. So now, when this happens, of course, you have a sovereign crisis in one country, but also, like in a classic exchange rate crisis, you have contagions to all the other weak elements of the chain. And if your institutional framework is not right, things may take a systemic proportion. And this is what we are seeing today. So the market doesn't believe in you. That puts a pressure on interest rate. That makes your numbers very bad in terms of sustainability, which means that the market even less, he believes on you even less, which puts even more pressure on interest rate. And this makes your number even worse, and so on and so forth. You get in a loop in which it's very, very difficult to get out. This is called a self-fulfilling liquidity crisis. Now, if you are in that crisis, what do you have to do? I mean, you have to stop it, right? You have to stop it. You have to say, hey, creditors, don't worry. Somebody will step in. And who can do that? Typically, in every country in the world, is a central bank. When there is a liquidity crisis, the central bank says, I will buy government bonds like the UK is doing, the US has been doing. I will buy government bonds in order to stabilize the long-term interest rate. So the central banks, in periods of sovereign crisis, acts to stop self-fulfilling liquidity crisis. Okay, so this is a self-fulfilling crisis, and this is the loop in which now we are, in which you have default worries, so higher government bond yields, so tighter financial conditions, bank solvency concern, more banking financial strains, deeper recession, et cetera, and it's very difficult to get out of this loop. I mean, we have to address it somewhere, some part of this. The plan for saving Greece together with the IMF. So, okay, that was part one, dealing with insolvency, the Greek plan where, the governments and the IMF and so on, try to avoid the worst, which was not avoided. Plan two, put together a firewall, so an institution that could deal with liquidity and contagion. This is the European Financial Stability Fund, which is going to become the European Stability Mechanism. There was a deal agreed in March 2012. A lot of money were put into the table, but nobody believes that this money is going to be enough. Okay, so that in case of the worst comes to worst. And so because the money is not enough, at the end, everybody believes that if we have another escalation of the crisis, the ECB will have to get in even more heavily. And plan three is the banks, and very little is clear about what's going to happen on, who is going to put the money on the table for banks recapitalization. Now, what is missing? Growth. Okay, so this is this is where that was trend growth before the crisis. This is where we are, so not so good. Euro area governance, meaning that the South has to put the house in order, but the North has to increase demand, because the North is through this adjustment, which is the debate. Actually, as somebody argued, I read an article on the FT that were making exactly the same point. After Bretton Woods, Keynes said, talking about the German reparations after the war, that these guys were never going to repay the debt because they will not be in a position of doing it, and there will be a mess because you cannot, so when you have a credit crisis, you have the problem that also the creditors have to do their part. And I mean, what we had was Nazism and the Second World War. Okay, so that we are now in the same situation in which the Germans have to spend and sustain aggregate demand because they can do it, they have the room to do it, and only through that we can hope that the real economic activity will be sustain in the South, because only through growth we will be able to get out of this mess. Now, it looks like these guys are eventually converging to this idea, okay? So this is they're now talking about the growth compact and so on. But in the meantime, you have, very extremist parties, kind of flourishing. This is Marine Le Pen in France. This is the Greek, the right and the... Yeah, he is the left one, but these are the very bad guys, right? Golden Dome. Yeah, and this is Grillo. In Italy, the guy is an actor, because we have our own specificity. Okay, so I mean, what's the future? I think growth, but also deal with financial stability, Euro bonds, Euro-wide bank regulation, governance, and the most. We will see with the Greek default. Now there is no time to talk about it. I just have a slide. I think this will be a good test. If Greece goes, how are we going to prevent contagion? There will have to be more ECB action, more Europe, more fiscal, sharing of risk, because otherwise we are going to go under. And I'm not particularly optimistic these days, but I keep the finger crossed.
Lucrezia, thank you very much. Can I present you a gift from the school?
Thank you. Is it money? Liquidity.
Greek drachmas.